So this is going to be a fun episode, and I'm going to disclose right off the bat that one of the three stocks we're going to cover today is one that I personally own in my portfolio. So after watching the whole video through, make sure to comment down below and let me know your guess as to which of the three stocks it is that you think that I hold. If there's a lot of interest in this, I will cover this position in a future video as well. Now, I may consider opening up positions in the other two stocks that I don't currently hold, but we'll have to wait and see how the market trends over time and if I do find some good value in these stocks. At current prices, they are tempting, but there are some fundamental issues that I'm not a huge fan of. If those things iron themselves out in the short term, I may consider opening up a position there. Anyways, the goal with today's video is to cover three stocks that I think has the potential to double your money in 2020. Usually I look for investments that can, double, triple, and perform really well over the long term, which I believe most of my stocks will. But there are some opportunities like the ones we're seeing right now where there's certain great companies out there that could double or more in a short period of time, like in a year or so. But as always, if you're brand new here, consider hitting that subscribe button down below to join the community. And whether you're brand new to the channel or you're a viewer that's been around for a very long time, hit that like button down below to show your support for this video. But without further ado, guys, let's get into it. This is a very interesting stock, and it gained some popularity in the YouTube community at one point last year, but has since fizzled out. But after taking a look at the company, it may be worth looking into further here for some possible 2x returns in a short period of time. Here's the monthly chart for Toll Brothers, and we can see the stock has had some wild rides over the years, dipping to the $16 range during the last recession, only to come back to the $40 range most recently. And after this huge sell-off hit last month, Toll Brothers plunged to the $13 range, which was even lower than during the last recession. This right here is a good example of overreaction in the market, in my opinion, and investors realized this pretty soon as the stock got bought up quickly and now sits at around $22 a share. Now, just for reference, here's where the 2x gain would be on Toll Brothers. We were literally there just a month ago, and depending on how things play out with the global issue, we could be back there sooner rather than later. But before I discuss some of these risks, let's go over the business. This company is a luxury home builder and is a well-run company overall in a fairly competitive market. What they do differently is that they build homes for people that tend to pay a premium for their homes, because after all, these are luxury homes. They tend to cater to the high-end clients of the market, and unlike their competitors, this means that they have a pretty good niche covered. This also naturally means that they're a smaller company relatively, but their numbers are still pretty decent. Revenue for the company has been growing consistently, hitting $7.2 billion in 2019, a very strong increase from just a few years before. And across the board, we see some good growth here as well. Higher sales, higher cash flows, and higher earnings, which shows us that this is a healthy business. Their balance sheet is also solid as well, with over $500 million in cash currently and no short-term debt, so this business is in good standings for now. The company also pays out a dividend, although it's fairly new and currently yields just over 2%, but this should definitely be not a reason to own this stock. During tougher times like right now, it's very possible that Toll Brothers goes ahead and cuts this dividend to save some cash. And that kind of brings me to the risks with investing in a company like this. Depending on how long this global issue lasts, Toll Brothers could either recover pretty significantly and end off the year at 2x gains, or we could remain around the same levels that we are right now if this issue prolongs itself. Right now, the housing market is holding up pretty strong, but generally it does lag the stock market by around 6 to 9 months. So if things continue getting worse, we should see home prices start to drop pretty significantly towards the end of this year. However, on the flip side, if things go back to normal sooner than expected, we may not actually see much of a dip in home prices. We may see a slight dip, but it won't be anywhere near as significant as what we saw in the stock market here. And I'm not going to lie, if you're playing the stock for the shorter term, there is quite a lot of risk here because we don't know how bad this issue will be and how long long it's going to keep going, because the longer it keeps going, the worse it is for companies like Toll Brothers. Because just think about it logically. A company like Toll Brothers relies on people going in and looking at the homes and then putting offers in for the homes. And if we're all in a lockdown mode, you're not really out there looking at homes. It's probably one of the last things on your mind. So a company like this will get hit drastically. I know they're making some efforts for virtual tours and that kind of stuff, but it's still going to be a big pill to swallow for a lot of people to not see the house in person before they make that purchase decision. Also, this issue continues going the way it is. We're definitely going to see a lot of layoffs happen, and if that continues, a lot of people are not going to be able to afford these houses either. Maybe you have a job right now that actually enables you to afford a house that Toll Brothers builds, but maybe a couple months from now you lose that job and that's kind of out of the picture. So if that does happen, the stock price currently, in my opinion, reflects that scenario. Keep in mind that Toll Brothers is currently at a PE of 9, where the forward PEs, although most likely will be skewed, is sitting at around a 5. So on a historical level, this stock looks very undervalued here at $22 per share. And just remember, I did not say that these 3 companies that I'm covering today are low-risk stocks. In fact, they're the complete opposite. I believe they're all high-risk companies. And with the issue happening the way it is and escalating the way it is, all 3 of these companies could potentially be in trouble over the long term. That being said, Toll Brothers was at $40 per share just a few weeks ago here in February. And if we do see a recovery, I have no doubt that this company will rebound back to that level in short order. All right, let's move on to our second stock here. Now, Wayfair is a company we've actually discussed a few times on this channel, and many of you may have actually used this company as a consumer. They're an online e-commerce company that is focused on selling you furniture. Everything from a lamp to a couch to a rug, literally anything you need for your home. And they have such a vast selection on their website that it's become one of the most common places that people go to when they're looking for furniture for their homes. And honestly, as more consumers shift their spending online, even for furniture, Wayfair is positioned to take advantage of this, as they have done so already. Now, this company caught my attention because the stock absolutely fell off a cliff in the recent market downturn, correcting over 87% from its highs, which is one of the more drastic corrections I've seen. At a current price of $46 or so, I can definitely see the stock price doubling to $92 a share in short order. This company is trading at a $4 billion market cap right now, which I think is too low for this business. In 2019, Wayfair posted over $9 billion in revenue, yet, like I said, their market cap is around half of that at $4 billion, so it could potentially be very oversold here at these levels. However, taking a step back, looking at their balance sheet and financials, they aren't very strong. We can see the company has negative $330 million in net income in Q4 2019, so they're still not able to turn a profit. Now, they are sitting on nearly $1 billion in cash currently, with no short-term debt on the balance sheet, so they are in a position, in my opinion, to weather through this storm. But let me use this opportunity really to touch on this in more detail. With the current issue going on, everyone is pretty much forced to work from home. And with working from home comes a few things that you may have not thought of purchasing before if you always used to go into the office. Things like maybe a desk, a computer chair, maybe even a lamp depending on how your lighting is in the room. All these things become a necessity now as companies shift to a work from home model. So I mean, naturally a lot of people may just go on Amazon and try to look for these kind of things, but there isn't a lot of selection on Amazon when it comes to furniture. Alternatively, you could maybe go to Walmart, but let's be real, the quality at Walmart on their furniture and most things that they sell is not exactly desirable. They're typically lower quality stuff. Now, naturally, in a regular environment, your third option would be kind of like a specialty furniture store, but the problem is a lot of them are closed right now. So really, this presents an opportunity here for Wayfair because they're online only. You have vast selection and you can actually purchase quality products at affordable prices. And some of you may think this whole work from home movement is a short-term thing, but in my opinion, I think this is a fundamental shift that's happening in the industry, and it's here to stay. Because of that, I think a lot of people are actually going to spend some time and invest in proper furniture for their home office. And really, if Wayfair plays their cards right and does some good advertising here during these times, they can acquire a lot of new customers. And we're not really going to know how Wayfair is doing until they either make a statement on this, or we just wait for their earnings report for them to actually discuss how the quarter went. But until then, I think the stock is providing some pretty good value at these current prices. Now, if during the earnings report they say they had a huge surge of users come in and new customers and even repeat customers buy a lot of new furniture, we can potentially see the stock double in short order, and I can see this close to $100 per share in no time. The risk, of course, with this company, even though they are benefiting from this whole issue, is that they are burning a lot of cash currently. They need to grow exponentially to really have some positive net income come in. So as a long-term investment, this may not be the best company, especially if you want to look for good value companies. But for a growth investor looking for high growth companies that could take advantage of the whole issue right now, Wayfair is a good candidate. I'm still kind of waiting for them to convince me how they're going to turn their hundreds of millions of dollars in losses into hundreds of millions of dollars in profits. Our third stock for this video, Discover, is one that a lot of us as consumers have heard of before, or maybe even use on a regular basis. Many may only use this company for their credit cards, but they also have another huge portion of their business, which are loans, including home loans, personal loans, and student loans. The loan segment of Discover's business is pretty strong, and this is definitely something to consider if you are looking at this company for an investment. Because here you can see how it has consistently grown over the last few years with a compounded annual growth rate of 7%. They have a strong presence in student loans, which is also part of the reason, in my opinion, why I think the stock is down so much. Now I'm going to touch upon this in a few minutes here. But for now, let's look at the stock here. We can see it's corrected by 75% from its highs in just a few months, and it currently sits around $40 or so. So doubling it to around $80 is not out of the question. It was just at that price back in January, so this isn't that far-fetched. And you have to keep in mind that this company was one of the harder hit financial related stocks. However, they are a consistent business over time. We see double-digit growth pretty much across the board here for this company over the last 3 years, showing us that it's a healthy business that is required. Revenues have had a nice uptick in the last few years, going from $10 billion in 2015 to nearly $14 billion in 2019. This is a very steady and consistent growth pattern over the last 5 years. All of this also results in them pulling in very healthy free cash flows every single year, with 2019 coming in at nearly $6 billion. So you could tell this is a very lean business in the sense that they pull in $15 billion in revenue and have $6 billion of free cash flow as a result of that. Now they do pay out a dividend, which looks extremely attractive right now as well. The starting yield is around 4.5%, payout ratio around 20%, they have 9 years of consecutive growth, and they have a good compounded annual growth rate of around 13%. Things on this front look very good and healthy for the dividend. Now the company is currently sitting on nearly $7 billion in cash with no short-term debt due, so they are in good standing right now from a balance sheet perspective. Now I was actually curious as to why their cash dropped from $15 billion in 2018 to $7 billion in 2019. And after digging a bit here, it appears that they invested a chunk of their money in treasury securities. So from a high-level perspective, they are still sitting at a total of around $17 billion in cash and cash equivalents. So this is a good buffer for the company. So I mean, from a fundamental level, everything looks very strong with this business. They're growing, they have good free cash flows, they have a good balance sheet. Pretty much everything is trending in the right direction. So what is really causing such a huge sell-off here in this stock? Now I touched upon this just briefly here a couple minutes ago, but in my opinion, I think it's because of the loans portion of their business. When it comes to the fintech space, there's really 4 main big players: Visa, MasterCard, American Express, and Discover. Visa is the largest of the players, and Discover is actually the smallest of all the players. When we compare their charts over a 1-year period, you can see that Visa and MasterCard have performed pretty well, but the 2 laggards here are American Express and Discover. This is not a coincidence, and in my opinion, it is because American Express and Discover both have a loans portion to their business, and that exposes them to more risk. And with this issue in the US and the world going on right now, what's happening? Well, people are losing their jobs, and the prediction is that many will default on their loans. So who gets hurt from this? Not Visa or MasterCard, they don't hold any loans, but American Express and Discover, because they do hold loans. And you can see that's exactly why the market has sold off on Discover and American Express a lot more than Visa and MasterCard. And Discover actually holds a big portion of their loans in student loans. And unless you've been living under a rock, you know that student loans have been ballooning year after year and has been a pretty big issue out there in the economy for quite a while now. And with these uncertain times right now and people losing their jobs, the market is uncertain if people are actually going to pay back their loans to Discover or even American Express for that matter. And as a result, the stock has taken a pretty big hit because the market's expecting a big amount of defaults on those loans. Now, I think because the government is stepping in here with relief, it's not like a typical recession where, if someone lost their job, they have no income coming in, so defaults are probably going to go through the roof. In this case, the government is still paying people money, so we won't see as many defaults, in my opinion, as expected initially. But I mean, the government can't keep doing this forever, or maybe they can, I don't know. But the point is that if this recovery happens sooner rather than later, that'll be a good thing for Discover here, and people will once again be in a position where they can start paying off their loans again, and things can start going back to normal over time. So I mean, with Discover, the risk that you're accepting is that the defaults are not going to be as high as initially expected. There are definitely going to be some defaults, but if you're optimistic on the big issue really fixing itself or us getting past it sooner rather than later, then Discover may be a good investment opportunity here for a 2x gain in a short period of time. So this was a pretty interesting video because out of these 3 stocks, 2 of them could potentially face a lot more short-term pain if things continue the way it is in the economy and we don't get past this in a short time period. However, on the flip side, one of these stocks will continue benefiting from this, in my opinion, as the work-from-home revolution continues. I think it'll be interesting to see how things shake out over the next few months. But either way, guys, remember, I own one of these 3 stocks. I want you to guess in the comment section down below which company you think I own. I think based on the way I did my analysis here, it may be clear to you which one of these 3 I own. But either way, take a guess down below, and if there is interest, I will make a separate video dedicated to that stock as well. Guys, thank you so much for watching. I hope you enjoyed this video. Don't forget to invest positively, and I'll see you in the next one.